Hello, everyone. Welcome. I'm so glad you're here today. Whether you're joining from your office, home, or between meetings, thank you for taking the time to focus on something that truly matters, the financial stability of your community. As we wait for everyone to join, I'd love for you to participate in a quick poll. Okay, I'm going to drop that right now. So the poll is, I hope you can see it, on a scale from 1 to 5, how confident are you in your association's long-term financial stability? So go ahead and answer that poll while we wait. Again, the question is, on a scale from 1 to 5, how confident are you in your association's long-term financial stability? 5 being very confident, 1 being not very confident. All right. So go ahead and drop your answer in that poll, and this will help us tailor today's conversation. Is everyone able to hear us? See anyone in the chat? Alex, do you see the poll? Ah, there we go. Okay,
Yeah,
I'm starting to see results. All right. I see some 2s, some 3s, some 4s. Okay. All right. This is interesting. We're seeing a mix of confidence levels, which tells us that this conversation is certainly timely. Before we get started, make sure to take a moment, look at your environment, and remove all your distractions around you. So go ahead and close the door, turn on Do Not Disturb on your phone, try to remove as many potential distractions as possible. So we have your undivided attention and make sure you get the most out of our time together today. All right, I'm gonna end the poll now. All right, thank you for those participating in the poll. All right, welcome to today's webinar called Financial Stability in Florida Communities, Smarter Budgets, Stronger Reserves. My name is Michael Manrique, and I serve as the Director of Business Development for Affinity Management Services. For nearly 2 decades, our team has worked alongside condominium and HOA boards throughout South Florida. If there's one thing we've learned, it's this. Financial stability doesn't happen by accident. It happens through leadership. It happens through planning. And it happens through proactive decision making. Today isn't just about spreadsheets. It's about protecting property values. It's about reducing risk. And it's about giving you confidence in the financial decisions you make as a board. Our big promise today is by the end of this session, you will understand how to create and maintain a realistic, resilient budget, know how reserves protect your community long-term, identify financial red flags before they become crises, and walk away with practical actions you can implement immediately. Smarter budgets lead to stronger reserves, and stronger reserves lead to stronger communities. We have a lot to cover, so if we have time at the end, I will open it up to Q&A to the audience. Now, let's introduce our guest here. I'm very excited to introduce our guest expert. Joining us today is Alex Leonardo, CPA managing partner with over 20 years of accounting and auditing experience. Alex previously served as a lead auditor at Deloitte & Touche, one of the big 4 accounting firms, managing financial, SOX, and retirement plan audits for public companies. Today, his firm, Leonardo & Company, works extensively with condominium and HOA communities, developer turnovers, nonprofits, and construction entities. He also serves as a treasurer for the Broward Coalition and teaches continuing education courses for property managers and board members. In short, he understands both high-level compliance and the real-world financial challenges South Florida associations are navigating right now. Alex, welcome. We're grateful to have you.
Thank you. Thank you so much, Michael. I'm glad to be here.
Awesome. We're glad to have you. All right, guys. So let's begin with the foundation, which is budgeting. So Alex, how far in advance should boards begin their budgeting process, and who should be involved?
So I would say, what I've noticed over the 18 years and what best practices is and what I've determined and what I've seen is that, listen, if you're starting in July after the first 2 quarters for a calendar year, you're in the above average category. I would say the majority, they start in October after they have 3 quarters of actual numbers. And that's usually the case because the idea is that by the end of December, you have to have the budget, you want it passed. So then the coupons are being sent by the bank, et cetera, for the lock boxes. So that's the ideal situation. Who should be involved? The property manager, I would say the board members. And I don't mean just one board member. You should have more than one. This should be done together as a team. It takes multiple hours where one draft is prepared and then a second and then a third review. Ultimately, someone in the accounting department, the GL accountant, will review it for accuracy, but they're not going to know as much the substance as the property manager and the board.
Gotcha. So you're thinking that the budgeting process should begin, you said October, and multiple board members should be involved in this process overall.
Yeah, absolutely. And I would say this, and I'll try. I'll say this. On a lot of these tasks that you're doing, it's so important to include the other board members. There's always going to be a stronger board member who's comfortable, has been doing it for years, but it's very important. You want the perspective of the other board members, and also it allows that when things go right or when things go wrong, that the board takes responsibility as a whole, and you're not putting it on one person. I don't think that's fair, and it creates a better. It definitely creates for better integrity of the numbers that you're estimating, because these are estimates.
Gotcha. So what percentage of budget variance is acceptable before board members should be concerned?
All right, I'm going to be a little bit controversial here. I'm going to say any, and this is why. Your budget's, it's all relative, right? If I say 10% on a budget that's 500,000, well, that's 50,000. And that sounds reasonable, right? These are estimates. These budgets are done in by the latest December for the following year. They're estimates, and in any given year, you're going to have a surplus or you're going to have a loss. But 10% on $5 million budget, now you're talking you could have a loss that year for 500,000, and that might not be acceptable per se, right? What I like about that part, this question is this. It's really about what are you supposed to be knowing and doing as a board? You have to be proactive. If that year you had a loss, you have to look yourself in the mirror as a board and speak to your property manager and your geo accountant. Hey, can we afford this loss? Can we afford it? Do we have the cash to be able to absorb that loss that year? Or do we have to include this in next year's budget? And let me give you an example, just a general example. Let's say you have an association that has 50,000 in that has a $50,000 budget. I'm sorry, a 50,000 monthly expenses, right? They have that per month, and at the end of the year, let's say they have 200,000 in cash, right? In that particular year, if they ended up having 100,000 in losses, the board has to say, do I really have the money, right? I need to carry at least a month to 3 months in working capital, which is usually at least, in this case, I'm using 50,000 per month, right? So you should have at least 50 or 100,000 sitting in the bank. If you have another 100 sitting there, you could decide, hey, for next year's budget, if I have $100,000 loss, I could say, hey, I'm gonna in my budget, I'm gonna add 50 because I'm gonna raise my budget by 50 grand to replenish my operating account, and the other 50, I'm gonna use it from my cash that's been sitting there. And that's the kind of thought process you have to go through. And as we go through some of these, and we continue speaking about this, you're going to see there's a lot of angles. There's a lot of things you have to consider at that moment. because you have other objectives, you have other areas of concern regarding reserves. And as you're going to see when you're putting this together, it's like it's like getting a matrix, getting a board, and you're going to decide what you're going to focus on this year and what you cannot. You can't afford it, or there's only so much a community could bear.
Yeah, let's talk about maybe some other concerns that are hard to account for. How can boards realistically account for inflation or insurance volatility and vendor cost increases?
You know what? Before I go there, I thought about another example that I think people would understand, and I think it just drives it home when you talk about variance and budgets and
Uh-huh.
just acceptance, right? So last month, I was hired by a client who I've been performing the audits for 3 years, and they have a new treasurer that's been there a year. And they've hired me to do a separate analysis just to explain to the entire community what happened there over the last 10 years.
Mm.
Now watch this, guys. They had little losses. This is the annual budget, by the way, is 300,000, right? At the end of 2024, they owe the reserves 100,000. They what they did over 10 years with prior boards, right? They would get little losses, 10,000, 20,000. It just kept adding up. They never address these numbers, these losses ever. So they barely have working capital. But what did they really do? How did they fund 100,000 in losses with such a small budget? And it was these little losses over the years. They just used their reserve money. They basically used their reserve money. And there's right ways to do that. That in this case, that would be considered a violation. But I want to show you how this morphs into other where the community loses confidence in the board, right? They did this and they have these losses, and it's turned into stories of stealing and etc. Mind you, I'm almost done with the project, and I found where they did 30,000 in renovations through operating. No budget. The board just decided to do it. We obtained the invoices, and yes, you could see the company they use. They really did do the renovations. I confirmed it with prior board members. It was a real project. But did they address it in the future budget? No. They never said, you know what, let's put this 30,000 in next year's budget to replenish the account. They didn't do that. So they end up with this story that people are thinking, because people automatically, the general public thinks a loss automatically is negative, right? It's just a loss. Like if you were in a company that's trying to make a profit, that's what they see and that's what they know. And so here we are, a prior board that was very, let's say it, they were very tight belt with their budget, very tight, very conscious of raising it $1, right? But it leads to this level of lack of confidence. I have to pay me, a professional, to go back in there to look at all this and provide an analysis, private letter, to reduce the rumors. I have to go do this. Aside, and by the way, 3 different auditors have been there over 10 years. And every one of them shows the losses. It's there for everyone to see, but it just happens and it morphs into this other story. And this is what happens when you don't address these budget. When you have a loss, understand them. You got to understand them and then decide if you're going to absorb it or if you're going to put in next year's budget. But let's move on to the next question. Regarding inflation, how do you deal with it? How do you do insurance costs, et cetera, vendors? Here's what I would say to that. One, your property manager, one of the best practices, whether it's your property manager, if you're managed, or if you're self-managed as a board, is you go check with your vendors, right? During the process of creating your budget, hey, what's going to be the quote this year? Is there an increase this year? Is it 3%? Is it 5%? That is part of doing it. And the earlier you do it, the better you know, right? Because ultimately, as a board, you have a decision to make. Are you going to look at the situation and say, they're not providing them, you got to consider great service for the price that you're getting. And if you know early enough and the service hasn't been so great, then that might be the opportunity for you to obtain bids and either keep them or you end up hiring someone new. But and let them know about it, right? You let that vendor that you had for a couple of years know about that. It would allow it's going to deter them, I believe, to a certain extent of on their increases. If they were thinking 5, maybe they're going to do 3%. So it's something to think about. And as long as they know that the board is being conscientious about it, they would understand. Now, at the same given token, this industry is any vendors that are in our industry, they're usually only in our industry because outside this marketplace, they would charge more. I believe that because our system is so unique with the whole process of passing budgets. You find out really quickly who belongs in our industry, who doesn't, who's willing to take the lower margin for volume and good service. So you definitely have that going for you as an industry because of the whole budget process, which requires some level of involvement. The insurance, that was very hard. I would say that I over the years, the last couple of years, when the insurance went really high, the agent, you ask them, they'll tell you, hey, 10 to 12, 10 to 15%. But when it's time for your renewal in June, it became a different percent. And we saw a lot of special assessments on just for insurance increase premiums for the year. So that was very unique. You don't see that all the time, but the magnitude was so high that they had to do that. One of the things with these insurances that also happened is these increases made boards look at what can I do repair wise to reduce it. I'll give you an extreme case. I had a client where they went out without insurance for 3 months on purpose to get their roof done. Their insurance was so high, I think it started representing 50% of their budget. That they redid all their roofs that was, they were 2 years away. And with the new laws that came out, they just said, you know what, let's just do the roofs. And they did to get a better premium. And then they went back and finished their insurance. And they got their new insurance. It was lower, but it was still increased. But that's what it takes in regards to best practices, staying in front of the vendor cost. And that's what you need to do as a board, and that's what you instruct your property manager to do.
Gotcha. So what would you say would be the best way to communicate necessary assessments to increases to the homeowners or members of the association?
I would say it's really about being transparent, right? To me, you talk about having, when, and we'll get into it and when to have a reserve study, et cetera. But it is about being transparent across the board. The more you keep not expressing that and communicating that with the community, the more you're putting as a board on your shoulders. All of a sudden, these are your neighbors, these are your friends, and then you're going to increase the budget that year. That should, having the reserve study, having them in front of the community, having the meetings with the engineer, fighting, having these great debates with between the engineer and the board. Hey, why the roof? Can we get another vendor to come see what the true cost is? Because we believe it shouldn't be so high. Having those discussions in front of the community before you finalize a reserve study speaks volumes about you as a board, and it shows the community that you're fighting for them. And it also shows them that you can't control all the expenses.
Right.
And believing there, when you speak to these type of management companies, et cetera, there are different ways to address all these costs, and you'll be able to. But it starts with that. That's how, because by the time that comes and you get to your annual meeting, you're going to get very good by being transparent. You're going to get very good at presenting it to your community, where you're going to tell them, listen, if you want the Cadillac, here's your increase. I got option 2. Here it is. And here's your third. All of them are going to be reasonable because you've done the work. But it's the idea you put it on them at the community, and they know.
Yeah, one of the things. Yeah, one of the things that we advocate at Affinity Management Services is townhome meetings, especially for that reason specifically, right? If there's an issue that is going to be awkward or cause some sort of discomfort, it's better to have full transparency, allow for open dialogue in a townhome setting, you're able to get that dialogue going, and people are able to see both sides and feel better about the process overall, instead of creating those stories that you were talking about, right?
Yep.
Where they start saying, "Oh, why are things going up? I don't see it in the budget." They don't understand why it is, and then the stories start happening. So, and to your point, right? These are your neighbors, your friends. Um, you don't want to have animosity, where you live. Your home is supposed to be somewhat
Mhm.
peaceful and relaxing. So, transparency and having town home meetings are really valuable in completing that process for sure.
Yeah, and I'll say this, like I can't stress enough, like the less you're transparent, the more you're creating a vacuum that they are going to fill. Let's be clear about that.
Right.
Someone's going to get on the board, or two or three, with absolute vengeance on what happened, etc. And then they have to find something. And there's nothing there.
Right.
And listen, I've done the fraud cases. They've been in the news, and yes, for 1.5 they stole, etc., all that. But most of the time I'm walking new board members like, hey, let's get to your financial statement. Let's talk about that. Let's the what's so nice about South Florida and Florida in general, and I can tell you I have experiences outside this state where I've done some work, and I've spoken to other peers outside Florida. We've gotten so good at creating packages. Like, it's not just a balance sheet and income statement that you're getting as a board. You're getting the bank recs. You're getting the bank statements in every monthly, and you're getting the AR to know who's not paying. It's there for you. You could really see what's going on regards to that, and be able to explain it to a community. And I try to do that with these new board members that have a certain agenda, and they're being they and it's not that they're being dishonest. It's just they're frustrated. They don't know. And we have to educate them and show them, look, this is what happened. And this particular board decided to go left on this particular issue. Where you disagree and you said maybe you should go right. And management style is not a fraud, right? You got to be clear about that. If you spent the money, you put the board members there and they decided to do a lobby when you couldn't afford it, that is not fraud. If they did it and they did a good job, unfortunately, that board was given that authorization. So very important. Transparency wins the day every day in these
Gotcha.
matters.
Last question for the budgeting. How often should associations revisit and adjust their budget assumptions mid-year?
Um, to me, so the way I like to do it, if you're doing if you're really putting in the work on your budget, um, you when you go into budget season should be when you look at all the angles regarding preparing a budget. Um, it's very possible that mid-year happens. We've only seen that with the insurance where it was so material that they had to
Mhm.
stop in their tracks and say, I don't have cash to get to the end of the year. I need 100, I need 250,000 because the insurance completely changed on us. Then yeah, I think those things will be observant. And as you're looking at your financials as a board member, those things are going to be very apparent to you of you have dramatic losses. And that's when those conversations starts. But definitely the catch-all is going to be doing your budget workshops.
Gotcha. So definitely one of the patterns we see is that delayed increases often lead to larger corrections later. You gave some stories reflecting that. So proactive adjustments lead to proactive stability for sure.
Yeah,
So
it's so incredible. I'm sorry, Michael. I get so passionate about this.
right.
Um, Last year, I have in Singer Island. Um, I do three clients. They're all separated, but they're all related, right? They're like they have similar names, so they know each other, and they do have a master. Let me take that back. They do have a master association, but one of them, incredible. They have been proactive for years about how they did stuff, and they had a new board member come in, and she was great. She just questioned. She just, hey, why did you do this? And the answers were awesome. They were incredible, right? They did the seawall. They did the seawall years before building two and building three decided to do it. It cost them a third. of what these other guys are dealing with. So
go.
one of the things as we're speaking here and you hear this, there's something to be said about just getting started. At the end of the day, have some funding. So then later, when the unexpected happens, it's not so big.
Yeah.
And you can't get away from that. I've been in Miami. I've done the really high-rise buildings, beautiful building next to them, the same building, same developer, separate condominium buildings. One has not been taken care of. The numbers are incredible. The $50 million essays, it's tough. Versus the other building that has done and has stayed on top of it. And yes, people complain, but they're not complaining now. You know what I mean? So it's very important. It's just having a diligent plan year after year.
Gotcha. So actually, this is a great segue. So let's move into stronger reserves, because reserves are protection, not punishment, right? So what are the requirements for associations with over 3 floors?
4 floors. You got to have a SIRS study, and it was supposed to be. You got to have the study done by 2024, and they extended the funding to the 2026 budgets. There's an exception here and there regarding milestones, etc. But overall, the idea, the intention was have your study done, your SIRS study by the 2024, and funded by 2026. And I also mentioned this, regarding when you're not speaking about the non-SIRS, you got to speak about non-SIRS, right? And I want to break that down because these are the old rules, and it still works for non-SIRS. With non-SIRS, the idea is you're not required to have a study, but definitely best practices, especially with condos that have bigger obligations than an HOA. And you do the study, and it'll tell you, hey, here's my funding amount, the fully funding amount. And then you as a board and as a community decide, am I going to fully fund or partially fund or waive it? And I'll tell you some of what we've seen with the onset of the SIRS and dealing with that. There's been boards, the community have said, hey, for the first 2 years, we're going to fund the SIRS as we work all this out, and we're just going to waive the non-SIRS for the moment as everything comes into pieces, because some of them are having 40-year certification done, right? And you hear me talk about that more. Those major projects are going to change the complexion of the community, and the funding sometimes goes down because you got these things done, and what we're required in the future is going to be less. So there's a lot of moving parts in that. But yes, the SIRS is required, mandatory for condos, and the idea is, and non-SIRS are not. And HOAs, you could do your non-SIRS, etc. I've seen that a lot for the bigger HOAs.
So what are the biggest misconceptions boards have about reserve funding in general?
I think it's funny. I just got off a call with an HOA. They really don't. They don't want to do it on an HOA, and because they feel like it's an obligation. Mind you, this is a non-SIRS,
right?
And I get why the rules are a little bit different for HOAs. The obligations are smaller, but this community has a $4 million budget. It's a little city. It has a lot of things going on. It doesn't help when you don't have that non-SIRS study. And I told them, listen, it's a guideline for non-SIRS, right? It's the idea of this is your number. And you as a community, as a board, your homeowners don't even vote on this. I would feel really good as a board if in my HOA study said, hey, the funding for fully is 200. But as a board, because of the circumstances, the community, how they've been over the years, well, as a board, we're going to recommend only funding 100. But at least I told the entire community, right? Hey, this is what it really takes, but this is the number. And there was an engineer, and it's an independent professional, not me as a board making estimates on our own and adding our subjectivity to it. So that provides a level of professionalism and integrity to the numbers you're presenting to your community. So it's definitely something that I would tell you to think about. On the non-SIRS, you have that going on. On the SIRS, yes, it's mandatory, But all you could do as a community is do due diligence, right? Who do you hire? Who do you hire to do your serves? And getting your hands dirty, rolling up your sleeves in that process. Don't just accept these numbers for what they are. You should be involved from the beginning. Make sure you signal to your vendor who's doing the reserve study that you will be involved. You don't want a cookie cutter serves. You want to know why those numbers are there, because um, it's actually holding the board to a higher standard because it's mandatory. This is not non-serves and you could partially and waive it, etc. If that number states X amount, that's your amount, and you better have done your work. Everybody involved, because you're about to ask everyone for that money. So you want to make sure you have board minutes, you've had the meetings, you have the public meetings, because I'm sure if the number comes in too high, you're not going to be happy. So is not the unit owner. So the best you could do is just present it in that case. You know.
Gotcha. So let's talk about worst case scenario. How can associations recover if reserves have been historically underfunded?
So one of the major things that I've seen a lot over the last 2 years is because they are underfunded, but it's kind of coincided with the 40-year certification, right? And the milestone. You know, Miami was ahead of this, and then the state decided they passed a law for everyone to do it, depending where they are, etc. But that really pushed forward of the idea of obtaining a loan, making all those changes that they need to do to meet the requirements, and then the special assessment. They assess the community and they pay the loan over the life of the loan. And let me step back for a little bit there. What's unique in our industry is, and they do a really good job. By the way, our industry has the best rates of any industry. The banks consider this one of the lowest risks that there is, because the risk is being mitigated by unit owner. The boards control the revenue. So you guys get the best rates. The turnaround on underwriting is within days on millions of dollars. You don't see that in any other industry. But here's what's really nice in the products that are out there. If you're using what I like to say, condo banks, you got to use them. They know our industry really well. There's some covenants that they just don't put in our industry that they do in others. So keep that in mind. But the idea is you're able to get a line of credit, and it's usually for a year, 2 or 3, depending on the project. And the minute that you finish the project, it converts to a term loan, and it allows that during that window you could. And there's all types of ways. We've seen it all, right, on how to approach that. Where you might tell the community, hey, if you pay by this date, you're not going to be charged extra. No interest. You're not attached to the loan. You paid your amount, or they get the project done, and then they come up to the final numbers. And for the people that selected installments, they're going to pay over time, and they pay it towards the loan. So it lands the plane a little bit softer. When the project is all done, the great thing about that, especially these 40 years and the milestones, it's awesome, because now you're going to have another study done, and everything is in New York. Right. So the obligation becomes less. So that's what I would say to that, regarding that.
Gotcha. So the big takeaway here is underfunded reserves don't eliminate expenses. They essentially postpone them. And often postponement increases financial pressure, right? So let's go ahead and transition to risk management and financial oversight. So smarter budgets and stronger reserves require disciplined oversight. So Alex, what financial controls should every association implement to prevent fraud or mismanagement?
Here are the best practices. Dual signature. You should definitely be doing dual signature on all vendor checks. You should be using lockbox. And when I started in this industry, lockbox was not as prevalent. And then, people still had even cash at the management office. People stopped doing the cash, but it's gotten to the point that even the lockbox don't accept them it's becoming a best practice. Don't accept them in the management office. You're not accepting cash, you're accepting checks. But even that, it should go to lockbox. And obviously, for many years now, you keep promoting every year ACH, etc., and do that. You'll see that as well to create a little bit of automation there. But lockbox, major projects, obtain bids, be part of the process. Obviously some are more integral than others, and there's only few that could do those type of major projects. But overall, the material contracts that you have a bidding process. It's very important. Sometimes you have to set up a committee to do that, depending on the situation. One of the things that I've seen overall, and I've seen with Affinity's work and a lot of these management companies, the checks, they're using third party. You talk about control, not fraud, not having fraud. They don't even write the checks, right? It's a system where you're going online and 2 signatures have to be there for the check to be released by a third party, not even by your management company. So that's where the industry has gone. That's where best practices are. That's where you want to be. I cannot tell you enough. I train I have my annual meetings, I have individual meetings, but a full annual meeting is required in my quality control for our firm. And I implore on them, these audits are not forensic audits. These are financial audits. They're not actually designed to find that. But I feel like as someone here that lives here and what we do here for the industry, I tell them, listen, make sure you look at this and this. One of them that I wouldn't mind disclosing with you is I tell them, make sure they have dual signature. It's not illegal to have one signature, but make sure they have dual. If they don't, I want it on the letter of observation and I want to let them know. Because having one signature and then the board changes and then a new board member comes, you don't know them. You got to have some level of control, because control shouldn't be based on the person you trust. Control should be, hey, listen, make believe everyone's stealing, right? Will my controls hold in place? That's the real fiduciary responsibility of a board. Do you have the controls in place for any type of unknown risk that you know and don't know? So keep that in mind.
Gotcha. So how frequently should financial reports be reviewed, and by whom, in your opinion?
Ideally it's monthly, but I from my experiences talking to boards and with management companies and in the major projects going on right now, I totally see where that takes a bit of a back burner. The idea is at least every quarter. You should be able to sit down with your property manager, the board member, the treasurer, or the treasurer and president, sit down with them and go over that. What's so nice about these financial packages, now you have actual versus budget. You see where it went over. And in there, they have a GL. So if your landscaping went over, which is a contract, now I'm not talking about extra work, but just the regular, and you see that it went over, you could go to the GL and you could see, well, did we pay them twice? What's in there? Or it's a miscoding. That is the level that I want to see boards at, where they're able to see that. And then the AR, wow, that's incredible. The AR has a 30, 60, 90 days. You know who's late. And now the softwares a lot of times even tell you, is it in collection? You ask the property manager, what's going on with that? Oh, it's in foreclosure. We're going to get it, in 2 months, it's going to be ours and we'll sell it, etc. So ideally you want to do it quarterly. And the most important is December. I can't stress that enough. At the very least, you got to work really hard on your December with your property manager and clean it up. A lot of things get stuck on the balance sheet. Ask the question. You don't have to have a background in accounting to be able to say, hey, why is that there? Does that need to be cleaned up before it gets to your auditor? Because the minute you send these December packages to your auditor, you should not change them at all. They should be final version so they could get done the audits. And I would add this regarding, remember this year is changed for condos. By May 30th, the audits or reviews or comps have to be completed. In HOA world, it's still April 30th. That's the last deadline regarding that.
Gotcha. Yeah, one of the things that we really pride ourselves with is having our managers trained and being proactive in having conversations about the financials with the board members in their monthly meetings. So the board doesn't have to feel like they have to carry that burden. They could ask questions and feel like they're able to advise instead of having to do all the legwork when it comes to managing and reading financials. Next question: what role should finance committees play in strengthening financial oversight?
Um, what I like, with the committee, I think it's important to document. Like, for example, if you do the quarterly financials, so this is what happens. This is I don't like the idea. I've seen this a lot where they use the finance committee just for the audit. I don't like that to be the only agenda, because they're really having, when they have challenges with it, or the conclusions, or the losses that the association experienced that year, they really have issues with the board or their management, right? It's not, my numbers are the numbers. And it's what I always like, when you have a finance committee, have them involved at least quarterly. They should look at the financials. And you'll notice when you're looking at this, you could usually look at your quarter and say, hey, these are the 2 reasons or the 3 reasons we went over budget. It's not that complicated. You could look at it and say, all right, this is what happened. We had an AC repair for 10,000. It's not part of reserves, and we had it through operating, no budget, right? That should be able, everyone should be unison on that. The board, the finance committee. So by the end of the year, if you had 70,000 in losses, you should be able to explain it in a sentence. This is what happened. Pop, pop, pop. And this changed. And that caused, so that allows everybody to feel comfortable, right? Because everybody was involved, everybody was doing oversight. Not wait until the end of the year, I have 100,000 loss, and it just creates, the way you approach the property manager about it, what happened. And, you want to create that type of teamwork, and it requires you to have oversight more on a periodic basis versus waiting at the end of the year. And I think the committee doing that and then doing the audit works really well when it comes to using a finance committee. It doesn't mean you always need a finance committee, but there's a lot of reasons for doing that. I've seen communities where they've had boards that were not very transparent. And when the new board has come in, I've said it myself, I recommend you to have a finance committee. You need it. The 2 or 3 people that are screaming the loudest at the event, have them on the committee. This should be transparent. Let them deal with the numbers that you're dealing with. Because as a community, as a board, I hate to say it, it sounds like, having Congress, right? You have expenditures, and you have everybody wants to fix everything, but nobody wants to pay for everything. So you got to prioritize. What are you going to do? What you're not going to do? And having them involved in that process makes them part of the management, whether they're a committee or not, right? They get to see it. They get to see the limits of what you could do. You can't double the budget. And you're going to focus on this year, you're going to do this. Next year, you'll do something else.
Gotcha. So what are some early warning signs that indicate a community may be heading toward a special assessment, in your opinion?
I would tell you on your audit, this happened to me multiple times. If you just look at the balance sheet on your audit or review or compilation, and you see fund balance deficit, that should trigger something in you. You should find out, why do we have a deficit? That means, and I'll try to peel it this way. An association could have cash on hand and be broke, right? I could have 200 in cash, but I owe my vendors 300,000. That makes sense? So that doesn't happen like that in our industry, because our vendors are month to month and you got to pay them. But you could have that money in cash because you have a high prepaid of assessments that were paid, or you're borrowing from reserves, which you're not supposed to. Or your special assessment money is sitting in operating, but it's supposed to be in the special assessment account. If you have a deficit, you're ultimately going to run out of out of money. You're not going to have working capital. So it's a big sign. One of the things that we did like 2 or 3 years ago, we started putting notes on almost every deficit in the audit report saying, hey, you have an operating deficit, et cetera. We just noticed how the boards and the general public were just not educated on it. And for those that don't know, when we say the word fund balance in our industry, that means net worth, right? That's your assets minus your liabilities. If you have more liabilities than asset, like in your personal life, then you're in a negative. And ultimately, it's going to catch up to you where you don't have enough cash for your daily, monthly operations. So those are big warning signs regarding that.
Gotcha. So the biggest takeaway here is the strongest boards don't operate alone, right? They rely on structure, reporting, and expert guidance. Let's move on to communication and board leadership. So financial discipline without communication creates tension, right? And leadership requires both. So how can boards build homeowner trust when tough financial decisions must be made?
I think and it's about it's about removing and being transparent. It's having that mindset. Don't carry that burden. Sometimes when you need to listen, you need to hear the experts. You're gonna have to have the meetings where everyone's available and they can hear it. Have them involved in that process as you're about to make a big decision. You're gonna pass a special assessment. You know, what I see boards do, they'll say, hey, listen, we need to attack this problem, and we're considering a special assessment, and let them hear that for the next 2 months as you're going through your due diligence and picking your vendor. And you have the vendors interview, right? Sometimes publicly, you have the vendors, they have a quote and they're presenting to the community. Let everyone see that process, because I'll give you an example. The bigger the number on the repairs, the more likely that you might have a change order, right? And you don't want the community to second guess, what has been done. And that takes by showing them, hey, listen, we did our best. We picked the best vendor that we thought possible. We put in the hours. We did the workshops. We did everything. And then ultimately, you did the overseeing. That ultimately, if you do have a change order, it's because it's required, right? Some of these restoration projects, the minute they start breaking the wall, everything stops. They have to look at it and say, well, we did not anticipate this. You have a new problem, right? So those are the things that you have to do, and you have to do it through formality, et cetera, to really gain the trust of your community regarding that.
All right. What's the best way you feel it is to educate new board members on financial responsibilities?
I would say I really like the certification classes, the board certification classes. I think that's important. And I don't care if you're on an HOA or a condo, just do it. Listen to the lawyer speak to you. I've had so many board members, and when they're asking me this question, I could just tell that they just never heard it before. And you should start there. It adds credibility to you as a board member as well. And it creates a kind of professional consciousness on decisions you're making, on behalf of the association. So I think certification classes, I think more than ever, the management companies, they do these workshops, these type of meetings that you're listening to now. That's what it takes. That's what it takes, because now the days of having just a regular operating and replacement account is far and in between now. It's now essays are involved. So you will be judged in a more strict manner, unfortunately. And so it's just about being educated from all these things. I think one of the things that happened after COVID is it's everything went from going on site to doing a webinar to so many of them are online. So it's really very accessible to everyone. So I find there's no excuse to that. And I think that's one of the greatest ways to get educated.
Gotcha. You've been talking a lot about transparency here, but really, how transparent should a board be when discussing reserve shortfalls? I don't know if you have an example you could share.
And I'll start with this. when you have issues, when you have a shortfall, when you have any particular issue, don't walk into the meeting just with the issue. Walk in there with the solutions, even if they're not, if they're not great solutions per se, right? They're not. Listen, I got to do a special assessment, right? It's not the most but go in there with, hey, this is what happened, and here are options 1, 2, and 3. So never walk into a meeting without that. Ultimately, if you're going to determine that something that's been determined is an issue, so that's what I see in that.
Gotcha. How do strong financial practices improve overall governance and board confidence?
One, they're not going to believe it, but over time it costs you less. When things do happen, like a hurricane, you're going to get the utmost trust from the community as you're making the hard decisions, right? Like, you guys have emergency powers, where you might take your non-serve money and use it all for the hurricane because you're betting on the insurance claim, and it's going to take 2 years to get the claim, etc. It's just going to create a better, healthy environment for everyone, especially you for the volunteer. And if you're in that position, that means you're going to stay there, and you're going to stay as a board member, and you're going to have continuity. I have boards where they switch every 2 years or a year, and we can't get it off the ground. I've had to disengage on clients. You're 3 years behind, and you're not taking care of your responsibility. But it's created that environment over not being transparent, not being steward about what it really costs to run the operations, and putting that out there and living with it. And once you do that, it helps the other board member, right? The new board member comes in, then they're not dealing with this inherent issue. It's more about just putting their point of view on this platform that was created by the prior board, that was proactive, transparent. Here are all the numbers from every direction, and this is what we're doing. This is where we prioritize 1, 2, and 3. And if you want to do 3, 2, 1 instead, go do that. But it provides even consistency in that, right? You get a new board member, and he's just given the keys of a platform, of a process, of a system. I've seen that. Wow, I have some down by the water, 55 and over community. Beautiful how they're run. Incredible. You get a new board member, they have their own workshop for them. They get taught this, and this, and allow them to make decisions. But it does have some parameters, right? Where people just can't go cowboy on the situation. So,
Gotcha.
yeah, there's so many benefits from that.
So let's take the last couple minutes here and answer some of the questions from the attendees. So Claudia asks, how far out do you take your budget to discuss with the owners? It seems like it's a 30-year community.
What are the one of the techniques, I think this is important, so you could, there's a nice little takeaway. So that case that I told you where I've hired and they have this $100,000 loss, they owe it to reserves, and the expenses were legitimate, right? So what I told them, listen, it's very impactful on a community of $300,000 budget to say, hey, I'm gonna add another 100,000 on top of it, right? Just to make it whole. I told them, listen, you have other obstacles. They have reserve issues. They have other little projects that they're working on. I said, why don't you just pay it over 2 or 3 years? Add it to your budget. There's something in our budgeting called surplus shortfall. So for example, you have 300,000 in expenses that you added up and you're about to assess the community. If you looked at your audit, if you looked at the numbers and you're like, Alex, I owe 100 grand, we still owe to the reserves. Well, you might put 50,000 in that budget. Your budget now is 350 or 325. And you put that rule, and it's allowed. The state allows you to put something called operating shortfall. And you put in that number to replenish the account and to transfer it to reserves. So that's a way to do it. Having a plan is important. It doesn't mean you have to fix it all in 1 year, but have a plan.
Another question is, what is the status on budget meeting to the community? I guess, does it have to be done every year? Richard is asking.
Say that again. I didn't hear it too well.
Essentially, does a budget meeting need to be done every year?
Yes. Yeah, it is. It's required to be done every year. I would say this: they do have. I've noticed this, and it's allowed. DBPR has allowed it. For example, if if you're working, if you haven't passed your 2026 budget, I've seen it that the 2025 budget is accepted for the following first couple months in the current year. And for example, let's say right now in February, you finally passed the 2026 budget. You don't have to go backwards. You start with March with your new assessment. But definitely you should do it every year. It's something that I see. It's one of the highest adoptions of all our regulations. Boards pass budgets.
Gotcha. The last question is, how much should HOAs fund their reserve?
How much do HOAs fund their reserves? Um, you always hear this rule about 10% of your budget, just as an off number. Me and my peers, we've discussed it over the years, and we our hypothesis on that is it comes from Freddie Mac, et cetera, and what they required. But really, it's more than that. When you do these things, you really need to know what is your cost, and then decide how much to fund it. You know, as long as you have a plan and say, okay, we're going to fully fund it partially or waive. And I don't know what that percentage is based on your budget. It could be 5, it could be 10, it could be 15. So you know, the 10% is like a rule of thumb that I've heard, not a requirement, but it has no basis because it's all relative to your association.
Got it. All right, guys. So in closing, financial stability in Florida communities doesn't happen by chance. It happens when boards commit to smarter budgets and stronger reserves. It happens when leaders choose proactive planning over reactive decisions. And it happens when financial conversations are addressed early and not delayed. Alex, before we wrap up, I'd love for you to let everyone know what's the best way to connect with you if you have follow-up questions or if they need financial guidance.
Yes, you know, I'm the managing partner of Leonardo and Company. Been around 18 years, and this is all we do. Like 90% of our work is all condo HOA and co-ops and timeshares, even some developer work. You could reach me. I'm sure your admin Michael would, you know, has our contact information for them. You can reach out to me. I don't mind answering questions. It's a fun part of my day that I get to do that and talk to people and stuff like that. So yeah, send out any questions you have. I'll try my best based on that. You know, one of the takeaways I would give to you all is just in general, you hear all this and there's so many details, there's so many angles to this. And when you forget these things, I think the best way to always remember is just having the mindset, right? That's the best takeaway. If you have the right mindset on being transparent, et cetera, it will lead you where you need to be to follow best practices because it's going to be logical to you and you'll figure it out. And here's the great thing about you're in this industry. You are allowed to use your lawyer and you know, boards speak to their lawyers to make the best decisions, or to the CPA or to the management companies. But usually it starts with the management companies. But if you need to speak to a lawyer, you have it, and you don't have to feel like you're in an island by yourself. So that's my takeaway for you guys.
Awesome. Thank you again, Alex. Your knowledge was amazing. It seems like you're definitely easy to talk to. I appreciate your stories. We truly appreciate your expertise today. Thank you so much.
You got it.
And for those of you attending, if today's discussion raised questions about your current management and how they're handling your association's budget, reserves, or providing financial oversight, Affinity Management Services is here as a resource. If you'd like to continue the conversation, simply click on the button on your screen to schedule a call with our team. It's an option to have a focused strategic discussion about your community's financial position and next steps. No pressure, just clarity and guidance. I want to thank everyone again for investing time into your community's future. Smarter budgets create stronger reserves create stronger communities. Lead proactively, plan intentionally, and continue building financial stability that lasts. Have a great day, everyone. Bye.
All right, everyone. Take care. Bye.